In this video, we are going to talk about top 5 financial advice that changed my life forever. So before starting, please like this video and subscribe to this channel for our future updates. It is not necessary for you to have a better paying job or receive an inheritance from a relative in order to enhance your own financial status. Many people will benefit from gaining a better grasp of money management, which will allow them to reduce their spending, improve their ability to invest and save, and attain financial goals that previously appeared impossible to achieve. It is possible to improve your financial situation even if you assume that you are imprisoned in a terrible financial situation with no way out. Here are the top 5 financial advice that changed my life forever. So let's start. Number 5. Start an investment strategy. Even if your financial resources are limited, small contributions to investment accounts can assist you in maximizing the use of your earnings to produce additional revenue. Inquire about 401 matching, which is essentially free money that your company may be providing you. Consider setting up a retirement account or other type of investing account for yourself. The first step toward greater financial health is to change your personal habits. Some of these changes will be more difficult than others, but if you remain devoted to this transition, you will end up with excellent money management abilities that will serve you for the rest of your life, and, in the meantime, you will have more money in your bank account. A well-constructed budget serves as the foundation of sound financial management. Take control of your finances by downloading a complete guide to budgeting right now. Your investing plan is determined by your savings objectives, the amount of money you need to achieve those objectives, and your time horizon. If you have a savings goal that is more than 20 years away, you can invest practically all of your money in equities. However, because picking specific stocks can be hard and time-consuming, for the majority of people, the most effective approach to invest in stocks is through low-cost stock mutual funds, index funds, or exchange-traded funds. Number 4. Save up cash to afford big purchases. If you are considering a large purchase, such as a house or even an automobile that you require immediately, certain types of loans and debt can be beneficial. Cash, on the other hand, is the most secure and least expensive method of making large transactions. Paying cash saves you from accruing interest and accumulating debt that will take months or even years to pay off once the purchase is complete. In the interim, the money you've saved can be placed in a bank account where it can earn interest, which can then be applied toward your purchase. Don't waste your money on services you'll never use. Although you may not routinely use streaming services or mobile apps, it is easy to forget about monthly subscriptions that charge your bank account even if you have signed up for these services. Examine your spending for costs like these, and consider canceling any subscriptions that aren't necessary in order to save more money in your pocket each month. The ability to manage and budget your money is essential for financial success. Ideally, you should be familiar with the 50/20/30 rule, which recommends that you spend 50% of your take-home salary on basics such as food and rent or mortgage payments, 20% on savings and debt reduction payments, and 30% on lifestyle decisions. Given that you earn $3,000 per month and have no debt, you should be saving $600 per month on your take-home pay. It's possible that your money will accumulate more quickly than you anticipate. Number 3. Build up your savings, even if it takes time. Create an emergency fund that you can draw from in the event of a crisis or other unforeseen event. Even if your contributions are insignificant, this fund may be able to protect you from potentially dangerous situations in which you may be compelled to borrow money at exorbitant interest rates or may find yourself unable to pay your payments on time, among other things. In addition, you should make general savings contributions to increase your financial stability in the event of a job loss. Make use of automatic donations, such as FSCB's Pocket Change, to help expand this fund and install the habit of saving money in your children. Utilizing your monthly spending patterns, as well as your monthly take-home pay, create a budget you are confident you will be able to maintain. When you're already ordering takeout 4 times a week, it's pointless to make a rigid budget based on radical changes, such as never dining out again. Create a budget that is compatible with your way of life and spending patterns. You should view a budget as a method to encourage better behaviors, such as cooking at home more frequently, while also giving yourself a realistic chance of accomplishing your financial goals. That's the only way this is going to work. Our most crucial strategy for saving money quickly is really straightforward: learn how to set a budget. If you have control over your budget, you have power over your financial situation. But where do you begin? Before you can begin to save money on a monthly basis, you must first have an understanding of your cash flow. Understand all of your incoming and outgoing revenue streams, including loan repayments, monthly bills, and savings contributions, in order to maximize your profits. Number 2. Track your spending to improve your finances. In the event that you are unsure of what and where you are spending your money each month, there is a strong probability that your personal spending habits could be improved. Spending awareness is the first step toward better money management. Track your spending across categories with a money management tool such as MoneyTrack and see for yourself how much you're spending on non-essentials such as restaurants, entertainment, and even your daily coffee. Following your education on these practices, you can devise a strategy to increase your performance. Make a list of all of your accounts, including your checking account and any credit cards you may have, and use this list to determine your spending and saving patterns. Examining your financial records will assist you in determining where your money is going. Anna Maria Lusardi, the DeNitt Trust Chair of Economics and Accounting at the George Washington University School of Business, advises having a sense of your monthly cash flow, that is, what money is coming in and what money is leaving your account each month. Prepare to make adjustments as you track your progress. It's well worth your effort to keep track of your monthly costs, since you'll be surprised by what you discover. Keeping track of your spending can be really beneficial in determining what is truly costing you and what is not as costly as you initially believed. As he points out, cutting your major fixed expenses, such as the cost of housing, transportation, and utility bills, can have a substantial impact on your financial situation and your budget. Number 1. Get a grip on taxes. Even before you receive your first paycheck, it's critical to understand how income taxes operate. It's important to understand how to assess whether or not your starting pay will provide you with enough money after taxes to meet your financial obligations, and, hopefully, to achieve your career objectives. However, there are numerous online calculators available to save you the trouble of calculating your payroll taxes by hand. You'll be able to see your gross pay, how much of it is deducted for taxes, and how much you'll be left with, also known as net pay or take-home pay, by using these calculators. A salary of $35,000 per year in New York City would leave you with around $27,490 after federal taxes and exemptions for the 2020 to 2021 filing season, or approximately $2,291 each month. Additional state and local taxes must be taken into account. To put it another way, if you're thinking of switching jobs in order to earn a higher pay, you'll want to be aware of how your marginal tax rate will influence your salary increase. Consider the following example: a raise from $35,000 to $41,000 per year does not result in a pay rise of $6,000 per year, but rather a pay increase of $4,227 per year. If you're thinking about relocating, keep in mind that the sum will vary based on your state of residency and the potential tax implications. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.